If you own gold and you watched it collapse while missiles were flying and tanker routes were under threat, you probably felt a kind of disbelief that is more dangerous than panic. Panic is at least honest. Disbelief makes people do foolish things while they still think they are being rational. What most people expected was simple. War begins, fear rises, gold goes up. That is the children's version of the story. It is neat, clean, memorable, and incomplete. Markets are not punished for being complicated. Investors are. What I want you to understand is that gold did not suddenly stop being gold. The rules did not disappear. The crowd simply confused the metal with the receipt. And when stress arrived, it was the receipt that got thrown overboard first. I have spent a lifetime watching people make the same mistake in different costumes. In stocks, they confuse a business with a quote on a screen. In real estate, they confuse a house with the mortgage brochure. In gold, they confuse a reserve asset with a leveraged trading product that only behaves well as long as the crowd stays calm. That confusion is what hurts them. If you remember one idea from everything I am about to say, remember this. There are two gold markets. There is the vault and there is the receipt. The vault is the metal itself, the thing central banks hold when they want an asset with no counterparty. The receipt is the paper claim, the leveraged fund, the futures contract, the algorithmic position, the borrowed exposure dressed up as ownership. In a calm market, those two things can move together. In a stressed market, they can separate violently. When that separation begins, the man who thinks he owns the vault discovers he only rented a receipt. That is what this reset is really about. The first mechanism is what I call the oil shock loop. People see war and think only about fear. They should think about oil. When a conflict threatens a major energy artery, the first effect is not philosophical. It is arithmetic. Shipping gets disrupted. Insurance costs rise. Supply routes narrow. Oil jumps. Then everything tied to oil starts getting repriced, not slowly, but all at once. Fuel rises. Transport rises. Food rises. Fertilizer rises. Industrial inputs rise. The inflation problem that central bankers were pretending they had under control suddenly comes back wearing combat boots. That is where the loop starts. Higher oil means hotter inflation pressure. Hotter inflation pressure means the Federal Reserve cannot behave the way risk investors were hoping it would. A market that was daydreaming about easy money has to wake up to a more stubborn interest rate reality. And the moment that happens, money starts moving. It moves toward higher yields, toward dollars, toward short duration safety, toward instruments that look clean and liquid in the middle of a storm. That matters for gold, not because gold stopped being a long-term store of value, but because in the short run a stronger dollar and higher bond yields act like gravity on the receipt market. The machine does not care that bombs are falling. The machine sees yield differentials, momentum breaks, and stress signals. It sells first and asks questions never. That is why a war can push gold down before it pushes it up. The second mechanism is the rate hammer. Most investors think only in slogans. Higher inflation is good for gold. Fear is good for gold. Monetary disorder is good for gold. Over a long enough horizon, some of that can be true, but the market does not travel in slogans. It travels through sequences, and the sequence matters. When oil spikes, inflation expectations harden. When inflation expectations harden, the fantasy of near-term rate cuts gets weaker. When rate cuts get pushed out, Treasury yields stay higher or go higher still. When Treasury yields rise, the opportunity cost of holding a non-yielding asset rises too. Then the dollar strengthens because global capital is opportunistic and not sentimental. The stronger dollar becomes another hammer on paper gold. None of that requires the long-term thesis for gold to be broken. It only requires the near-term pressure to be stronger than the safe haven narrative. That is what many people miss. A short-term mechanism can smash price without invalidating the strategic case. In fact, that is often how the best opportunities are created. I saw versions of this lesson again and again. People would tell themselves a good long-term asset could not fall because the story was still right. Then the asset would fall anyway, because the route between a sound thesis and a higher price is paved with liquidations, leverage, forced selling, bad timing, and human weakness. The thesis and the path are not the same thing. If you do not know the difference, you will quit in the middle of a sound idea. The third mechanism is the machine cascade. Modern markets are full of participants who do not think about gold the way a central bank thinks about gold. They do not think about reserve diversification. They do not think about counterparty risk. They do not think about the asset surviving a sanctions regime, a debt spiral, or a broken trust system. They think in triggers. Price breaks a level. Sell, momentum flips negative. Sell, yield rises. Sell, dollar strengthens. Sell, volatility increases. Cut exposure. That is the machine cascade. It has no philosophy and no patience. It only has instructions. When enough of those instructions fire at once, you get a paper event. That phrase matters. A paper event is not the same thing as a fundamental abandonment of the metal. It is a liquidation wave in claims on the metal. The crowd on television will tell you gold is crashing. What they usually mean is that the most liquid, most leveraged, most reactive claims tied to gold are being dumped quickly. This is the receipt market throwing up on itself. That is why I do not let price action by itself tell me what a durable asset has become. Price can tell you what forced sellers need. It does not always tell you what patient buyers believe. The fourth mechanism is the leverage spiral. This is where ordinary investors get hurt the fastest, because leverage is a wonderful way to turn a tolerable idea into an intolerable experience. A man buys a 2 times or 3 times gold product because he wants to feel intelligent without having to wait. He tells himself gold is going higher anyway, so he may as well magnify the move. That thinking always sounds smart near the high and always sounds ridiculous near the low. But the flaw is there from the start. He is not buying more gold. He is buying a structure. And that structure has needs of its own. Leveraged products rebalance. They are not passive vaults. They are living little machines that must adjust exposure as prices move. When the price goes against them, they do not have the luxury of stubbornness. They must reduce and reset. That means a falling market creates mechanical selling. Mechanical selling creates more downward pressure. More downward pressure triggers more fear, more redemptions, more rebalancing, and more selling. That is the leverage spiral. People who thought they owned a stronger version of gold discover they owned a weaker version of themselves. I have never seen borrowed conviction end well. Real conviction comes from understanding what you own, why you own it, what can make it fall, and how long you are willing to look wrong. Borrowed conviction comes from the recent chart and the hope that speed will replace discipline. The first can survive a reset. The second usually dies in one. The fifth mechanism is what I call the sovereign pawn window. This is the part that sounds dramatic, but it is really just accounting under stress. A country that pegs its currency, imports critical energy, and suddenly faces disrupted oil flows or surging defense costs does not get to have an elegant opinion about reserves. It needs dollars, not theories. Dollars. If the normal dollar inflow is interrupted while dollar outflows keep rising, the state has to fill the bathtub somehow. It can burn reserves. It can let the currency wobble and invite a domestic crisis. Or it can monetize something that still carries value in size. That something is often gold. When a sovereign or quasi-sovereign actor takes metal it accumulated over years and swaps pledges or sells it to raise hard currency, that is not a moral statement about the future of gold. It is a margin call in a tailored suit. The state is doing what a desperate trader does, selling collateral to survive another round. Most retail investors never imagine that central bank level or sovereign level stress can hit the gold market this way. They imagine official buyers as permanent support. They forget that the same institutions that accumulate in one regime can liquidate in another. If the bridge between energy, dollars, debt, and domestic stability comes under pressure, that is why I take official sector buying seriously, but I never treat it like a law of nature. Institutions buy for reasons, and under pressure they sell for reasons too. If you understand the reasons, you stay sane. If you only memorize the direction, you get blindsided the first time the direction changes. This is also where the historical parallel matters. The market has seen periods before when stress in oil-producing nations or dollar-starved states translated into gold sales. The details change. The underlying logic does not. Revenue weakens or becomes inaccessible. Obligations remain, currency systems need defending. Gold becomes the asset that can be turned into cash. Investors who understand that mechanism are not shocked when gold falls during geopolitical chaos. They recognize that chaos can create the exact funding stress that turns gold into liquidity. Now here is where the story becomes more interesting, because the receipt market is only half the picture. The sixth mechanism is the vault grab. When price collapses in the paper market, the public assumes demand must be disappearing. That is a lazy inference. Sometimes demand is disappearing, other times demand is changing hands. That distinction is everything. In a true paper flush, leveraged exposure is being sold while strong hands quietly absorb physical metal, or cleaner, unleveraged exposure. One side is de-risking because it must. The other side is accumulating because it can. The first side is dominated by time pressure. The second side is dominated by balance, sheet strength, and patience. That is why you can see paper weakness at the same time as physical interest remains firm. The two markets are not always voting on the same time horizon. One is voting on this afternoon, the other is voting on the next monetary regime. If you do not understand that, you will read the wrong scoreboard. I have always liked assets that do not require a committee's permission to remain valuable. Gold belongs in that group. It cannot be printed by a finance ministry. It does not owe you an earnings call. It does not depend on a bank promising to honor a deposit. Its weakness is that it does not yield. Its strength is that it does not lie. That is why central banks own it in the first place. Not because it is exciting, but because in a world of promises, it is one of the few assets that is not mainly a promise. That strategic truth does not vanish because the receipt market gets flushed. But here is the mistake people make on the bullish side. They take a sound strategic truth and use it to excuse a bad structure, a bad entry, a bad time horizon, or a bad position size. They say, gold is insurance, while buying the most unstable expression of gold they could find. They say, gold is a long-term reserve asset, while using money they may need in 6 months. They say, gold is protection against systemic disorder, while panicking at the first sign of short-term volatility. That is not asset allocation. That is self-deception. So let me tell you how I think about it. I do not treat gold as a lottery ticket. I do not treat it as a romance. And I certainly do not treat it as a place to borrow courage. I do not possess. I treat it as a specific tool for a specific job. That job is not to make me feel clever by Friday. That job is to give me a form of financial insurance against a world in which trust in paper claims can degrade faster than people expect. Once you understand the job, the structure follows. You want unleveraged exposure. You want a time horizon long enough to survive a reset. You want position sizing that does not force you into panic. You want enough liquidity elsewhere in your life that you are never required to sell the insurance during the fire. You want to know the difference between a price event and a thesis failure. And you want to watch the variables that actually drive the receipt market, not the bedtime stories people tell on television. Those variables are not mysterious. If the dollar remains very strong, if long-term Treasury yields remain elevated, if the Federal Reserve stays trapped by inflationary pressure linked to energy and war, then the receipt market can stay under pressure for longer than the crowd thinks. If those forces begin to roll over, if the dollar weakens, if yields soften, if policy shifts from restraint toward relief, then gold can reverse hard and fast, because the same money that abandoned it in a stress sequence will race back once the pressure system changes. That is why I do not stare at the explosions and call it analysis. I watch the pressure gauges. What is the dollar doing? What are long rates doing? What is oil doing? What is the central bank being forced to admit through its actions rather than its speeches? What is happening in the physical channels beneath the paper drama? You do not need omniscience. You need the right dashboard. There is another lesson here, and it is not about gold. It is about adulthood in markets. Adults do not ask only, is the story right? Adults also ask, who is being forced to act? Who is free to wait? And what structure am I actually using to express my belief? That question alone will save you from an extraordinary amount of damage. A short horizon can ruin a good asset. A borrowed position can ruin a sound thesis. A man who confuses price with truth can sabotage himself even when his broad view is correct. That is why the crowd so often ends up losing money with the right narrative. They had the right narrative and the wrong instrument, the right narrative and the wrong timing, the right narrative and no emotional liquidity. It is not enough to be right. Eventually you have to survive specifically. That is the real identity shift I want for you. I do not want you thinking like a gold fan. I want you thinking like a reserve manager. A gold fan wants vindication. A reserve manager wants durability. A gold fan argues online. A reserve manager asks what role the asset plays inside a larger system. A gold fan takes a weekly collapse personally. A reserve manager asks whether the fire sale has improved the price of long-term insurance. That shift changes everything. Once you think like a reserve manager, you stop demanding that every week validate your ego. You stop buying unstable wrappers around stable ideas. You stop acting as though the market owes you an easy path just because your thesis sounds intelligent. You accept that a good reserve asset can become a terrible short. Term trade, if it is held through the wrong vehicle, financed the wrong way, or sized for the wrong life. And then you become much harder to shake out. Now let me give you the operating system I would use here. First, decide whether your gold exposure is insurance, speculation, or trading inventory. Do not mix the categories. An insurance position should be unleveraged and sized so that volatility does not force your hand. A speculation should be small enough that being wrong does not change your life. Trading inventory should only exist if you have a defined process and the temperament to obey it. Second, do not finance your insurance. That defeats the point. If you need to borrow confidence, you do not own protection. You own a countdown clock. Third, maintain a separate liquidity reserve in cash or near cash instruments. The easiest way to become a forced seller is to let your emergency fund and your hedges live in the same bucket. When life hits, you will sell whatever is liquid. That is how people end up cashing out the very protection they bought for systemic stress. Fourth, watch the pressure gauges, not the slogans. A war headline by itself is not a signal. A sustained change in oil, the dollar, long rates, and central bank posture is a signal. The world is full of dramatic stories. The money follows mechanisms. Fifth, be emotionally prepared for a longer reset than the crowd expects. The worst week in decades can be a climax. It can also be an opening act. There is nothing noble about being surprised by duration. Sixth, when paper and physical diverge, do not automatically assume price has told you the whole truth. Ask what kind of holder is selling, what kind of holder is buying, and which side is acting under compulsion. That is a workable blueprint. Not a fantasy, not a slogan, not a prayer. I have seen men ruin themselves because they wanted every complex situation reduced to a bumper sticker, gold up in war. Stocks up when rates fall, houses always recover. Safe companies are always safe. Life does not reward that kind of laziness for very long. What pays is understanding the chain. This chain is not that difficult once you slow down enough to see it. War disrupts energy. Energy shocks inflation. Inflation traps central banks. Higher rates and a stronger dollar pressure the receipt market. Algorithms and leverage accelerate the fall. Sovereigns needing dollars sell collateral. Paper collapses faster than physical conviction does. Patient buyers begin to care less about the weak and more about the regime. That is the chain. And once you see it, the emotional fog starts to clear. You may still decide gold is not for you. Fine. You may decide your time horizon is too short. Fine. You may decide other opportunities are better. Fine. But do not make a major decision because you mistook a paper event for the death of the asset, and do not make an even worse decision because you treated a reserve asset like a roulette wheel. If I sound stern, it is because money punishes confusion. The man who understands what he owns can survive embarrassment. The man who does not understand what he owns turns embarrassment into destruction. So here is the question I would leave you with when the next phase arrives, and it will, do you want to be the man clutching a nervous receipt, staring at a screen, begging the market to stop hurting you? Or do you want to be the man who knows exactly why he owns what he owns, what role it plays, how long he can wait, and what price pressure actually means? Those are not the same man. One is renting a story. The other is holding a reserve. And in markets like this, that difference becomes your whole future. Let me add one more point that matters enormously. People hear the phrase safe haven and imagine a straight line. There is no such thing. A reserve asset can be correct and still be repriced lower, because the holders who most need cash are not the same as the holders who most understand the asset. In every serious reset, the urgent seller and the patient buyer meet at a price neither of them would have named a month earlier. The seller is thinking about survival. The buyer is thinking about regime change. If you know which side you are on, volatility becomes information. If you do not, volatility becomes identity damage. That is why I never laugh at a man who sells under pressure. I simply try not to become him. The market is full of investors who were not wrong about the world. They were wrong about their own structure. They owned an asset that required patience with money that required immediacy. They owned insurance through a vehicle that could not survive stress. They owned a reserve asset with the emotional wiring of a momentum trader. That mismatch is expensive. Gold can spend a season looking weak and still be doing its long job perfectly. If governments keep leaning on debt, if currencies keep being managed harder than admitted, if reserve managers keep distrusting paper promises they do not control, the reason gold exists does not go away. What changes in a reset is not the destination. What changes is the price at which disciplined people are allowed to think clearly.